company incorrectly calculated the fair value of its passive equity securities in 2017. Securities had an original cost of $12,500, and the firm reported a fair value of $15,000, but should have reported a fair value of $17,000. So the income statement provided here was the income as it was reported in 2020. And so they had sales revenue, they had an unrealized holding gain from this passive investment of $2,500, other expenses, and in this case we are not going to ignore income tax effects, and so this does get a bit more complicated. And so we do have an income tax expense of $9,400 for net income of $14,100. So that's the information as it was originally reported. Here's the balance sheet as it was originally reported. The net equity investment was reported at $15,000. There were deferred tax assets and deferred tax liabilities. We're going to talk about which one this is going to affect, maybe in the back of your mind right now. So if we have let's just kind of walk through that maybe real quick. If we have an unrealized holding gain, is that going to result in a deferred tax asset or a deferred tax liability? Again, we have to think about, okay, under U.S. GAAP, what is the book value of the asset compared to the Internal Revenue Code? Under the Internal Revenue Code, it's going to be held at cost. Under U.S. GAAP, it's going to be reported at the fair value. And so on the count of three, just again in the chat or on your own, it's DTA or DTL. It's going to result in one of the two. And so on the count of three, just kind of say it out loud. 1, 2, 3. And the answer is a DTL. Again, because the asset is more under GAAP, so we're in that greater than situation. So under U.S. GAAP, the asset is more than it is under the Internal Revenue Code. And so in that case, this will be a DTL. I provide DTA and DTL because on the test, similar to what we're doing here, you're going to have to figure out which one it is in some cases. All right. And then all the other accounts are kind of listed there. All right, so let's talk about the journal entry. Nice. All right. Good job. Most people got DTL. All right. Let's talk about the journal entry. Notice the smaller font. Anytime you see small font on one of these slides, that means there's a lot of work that's going to be going on here. All right. So let's kind of walk through this a little bit. So we do have a fair value adjustment account. So we have to think about what's going on with that fair value adjustment account, and that fair value adjustment account is gonna have. Sorry, I'm just laughing at the chat. The timing's a little off, so I'm not laughing randomly. And so there's going to be a full effect on the fair value adjustment account. So the full effect of this mistake, this error, is going to be captured in the fair value adjustment account. And so the restated fair value adjusted account balance should be $4,500 because the fair value of the asset is $17,000. The original cost was $12,500, and so the restated account balance should be $4,500. The as reported account balance was $2,500. And so what that means is we need to increase the balance in our fair value adjustment account by $2,000, which means we need to debit that account. So that's part of our journal entry. The full effect being captured in this asset, the fair value adjustment account. The second piece is the effect on the deferred tax liability. It's very important that you remember when we talk about the deferred tax liability, it's the tax effect of the error. It's the tax effect, not the full effect, the tax effect. Now, we're going to do a little bit of math, not too much, but the restated DTL account balance should be 40% of the fair value adjustment account. And so the total difference between the $17,000 that's reported under U.S. GAAP and the $12,500 that's reported under the Internal Revenue Code is the balance in the fair value adjustment account of $4,500. So the tax effect of that difference is 40%, given a 40% tax rate, is 40% of $4,500 or $1,800. All right, so that is the tax effect from the restated balance. The as reported balance, of course, is 40% of the original difference of $2,500 or $1,000. And so you can see that we ought to have reported a DTL of $1,800. We actually reported a DTL of $1,000. And so what we have then is an entry amount of $800 to the DTL, which would be an $800 credit, which is an increase to our DTL. All right, so we have two accounts, the fair value adjustment account and the deferred tax liability account. The fair value adjustment account is the full effect. The deferred tax liability is the tax effect. There's one other account that we have to think about. And so I want you to try to think about what you think that account would be. So again, count of 3. I want you to come up with that account name. 1, 2, 3. And the answer is retained earnings. Now, retained earnings, that is where the net income accumulates. So there's really two things going on with income if you think about it. There's the unrealized holding gain, but there's also a change in the income tax expense, and they offset each other. So you have the gain for the full $2,000. You have the income tax expense as $800. Now, the reason why it's not the unrealized holding gain account is because that account got closed to retained earnings. So remember, when we do these journal entries, it's all about permanent accounts, unless this happens somewhat, partly in the year or something like that. But they discovered this error, and that account has been closed. And so that's why in this case it's the retained earnings account. And the retained earnings account is going to capture the after-tax effect. And so again, the asset in this case has the full effect. The deferred tax liability has the tax effect, and the retained earnings account captures the after-tax effect. Again, this is just remembering that those temporary accounts got closed. All right, so the restated retained earnings is 60% of the $4,500. And so 60% of that gain, so in other words, there would have been this gain of $4,500. That gain would have had a after-tax amount of $2,700, 60% of $4,500. If you want to kind of think about it this way, you have the restated fair value account balance of $4,500 minus the restated DTL account balance of $1,800, and what are we left with? The after-tax effect of $2,700. Similarly, the as-reported amount is $1,500, which is 60% of the $2,500 fair value adjustment account balance, which again was the $2,500 unrealized holding gain. And again, the $2,500 minus the $1,000 in the deferred tax liability gives us the after-tax effect in retained earnings. And if you kind of think about it, then what we have here is a debit of $2,000 to our fair value adjustment account, a credit of $800 to our deferred tax liability. So this is one hopefully you can get, but again, on the count of 3, I want you to give me the entry amount for the retained earnings account. 1, 2, 3. And hopefully you got a $1,200 credit, because we know if there's a total of $2,000 in debits, we need a total of $2,000 in credits, which means that's what the retained earnings account entry has to be. I'm going to stop there before we do the actual journal entry in case there are any questions, because this is kind of a heavy sheet right here. I get that. I'll just give it a minute here to catch up. Good. Just another minute. Okay, let's move on. Somebody just said it's early. It's 11 o'clock. My goodness. I've been up since 7. All right, I'm also old. I'm supposed to wake up early. I don't eat my lunch at 5. I don't eat dinner at 4 o'clock though, so I'm not quite there yet. All right, so Again, the journal entry just filling in the information that we have, the $2,000 debit to our fair value adjustment account, and the $800 credit to the DTL, and the $1,200 credit to the retained earnings. Notice that the date is the date that we find the error and correct it. And so I will say sometimes errors can be quite difficult to understand their full effect, and so sometimes companies might take months to figure out how an error has affected their financial statements and the entry that they need to do. So this can be a long, drawn-out process at times. All right, so now to the financial statements. So we're going to start with the restatement of the income statement. Again, we're talking about 2021, what's going to be reported. And you should also be aware that sometimes the company will file what's called a Form 8K. And on Form 8K, they'll disclose the fact that they had a restatement, and at the same time, sometimes they'll represent all of their financial statements with the restated amount. So while this for sure would be presented with the 10K or the annual statements or annual report at the end of 2021, there may be an 8K filed with this information at any point. I mean, it could be in April or May or June or whenever. So just be aware that sometimes there's multiple disclosures of these restatements. It must be disclosed in the 10K, but oftentimes will also be disclosed in the 8K. And so let's talk ourselves through what's going to be reported as restated amounts. So sales revenue didn't change. Hopefully that's obvious. Now the unrealized holding gain, instead of being $2,500, should be $4,500. The other expenses didn't change, but because income before our taxes changed, our income tax expense is also going to change. Notice that the difference in the income tax expense is that $800 increase to the deferred tax liability. That's necessarily always going to be the case. So that, again, the deferred tax liability change captured the tax effect, and so that tax effect is going to show up in our income tax expense. And so our net income then, notice that's an increase of $1,200, and the reason why it's $1,200 is because we increased the gain by $2,000, but we also increased the income tax expense by $800, which means there's a net increase of $1,200. Notice that that $1,200 difference is also the after-tax effect that was reported as part of retained earnings. So just be aware of that. So again, looking at the balance sheet, this would be as originally reported. Can you help me conceptualize how the unrealized holding gain is affected? All right, so when we have the unrealized holding gain, remember that account did not get changed because it's been closed. So the account did not get changed. However, when I'm presenting my financial statements, my income statement needs to be restated. And so originally I reported a $2,500 gain, but I actually needed to report a $4,500 gain. It looks like you're already getting it answered, but I just want to be clear that the account balance in the unrealized holding gain or loss account has not changed. We just need to recast or restate our financial statement. So this is all about making sure that our financial statement users see an up-to-date and accurate income statement from 2020. That's what that is entirely about. All right, now turning our attention to the balance sheet. Again, this is everything that would have been as reported at the end of 2020, knowing that now some things have changed. First of all, the equity investment, instead of being reported at $1,500, it's going to be reported at $1,700. Now notice what I did here is I combined the equity investment account with the fair value adjustment account. And the reason why I combine it is because most often that's how it's presented. Most often you combine the two accounts, and so what we have is the net investment, instead of being $15,000, should have been reported at $17,000, and that's what we did here, is we reported the net investment at $17,000. There's no change to the deferred tax asset, there's no change to the other assets, but of course there is a change to our total assets because of the change to the equity investment account. Now turning our attention to liabilities and equity, hopefully you see that there is no change to other liabilities, but there is a change to that deferred tax liability. Again, going back to the journal entry, we increased that account by $800, which means that the new balance in the deferred tax liability is $4,300. The other thing I want to clarify is the deferred tax liability account balance captures things other than just this equity investment account. And so that's why it doesn't 100% match up. That $800 increase is included with a lot of other deferred tax liabilities, and so that's why we're reporting it this way. And then for the last two, hopefully you remember that there is a change to the retained earnings account, but there would not be a change to any other equity accounts. And so the $35,200 and the $43,500, of course. The $35,200 is the increase of $1,200 compared to the original balance of $34,000. All right, I think